market structure is the backbone of price action trading. It helps you understand where the market is headed, when to enter, and when to stay out. Without it, every trade is just a guess. In this video, we'll talk about market structure, the foundation of price action trading. We will explore the external structure to grasp the bigger picture, followed by the internal structure that helps us pinpoint precise entry points. We'll dive into key concepts like break of structure and change of character, which signal trend continuation or potential reversal. You'll see how the internal and external structures align for strong trade setups, and finally, how to apply all of this in real market conditions to trade with confidence and clarity. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. Before we go deeper, it's important to recognize the three trends that any market can be in: uptrend, downtrend, ranging or sideways. Let's break them down further. In an uptrend, the market forms higher highs and higher lows. Each peak is higher than the last, and each pullback does not go below the previous low. This signals that buyers are in control, pushing price higher and defending every dip. As long as this structure is maintained, we focus on buying during pullbacks to higher lows, especially near support or trendline zones. In a downtrend, the market forms lower lows and lower highs. Each drop in price breaks the previous low, and each bounce fails to exceed the previous high. This tells us, sellers are dominating, and the momentum is to the downside. Traders should look to sell the rallies, especially when price retraces to key resistance levels or descending trend lines. When the market lacks a clear direction and moves sideways between two horizontal levels, it's in a ranging phase. Here, price action is driven by consolidation and indecision. No higher highs or lower lows are forming. In ranges, traders typically look for reversal setups at the edges of support and resistance, or they wait for a breakout that signals the next directional move. Let's now cover some essential concepts that price action traders must understand to read market structure effectively. A break of structure, often known as BOS, occurs when the market continues in its prevailing trend. In an uptrend, a break of structure is confirmed when the price breaks above a previous higher high, indicating that buyers remain in control and the trend is intact. Conversely, in a downtrend, when the price breaks below a previous lower low, it forms a bearish break of structure, confirming that sellers are still in charge. This kind of structural break is a strong signal of trend continuation, and traders often use it as confirmation to look for pullback entries in the direction of the dominant trend. Next, let's discuss a related but more significant concept: change of character, or CHoCH. In an uptrend, if price breaks below the most recent higher low, it suggests that buyers are losing control. This forms a bearish CHoCH, and it's often the first sign of a possible reversal to the downside. In a downtrend, if price breaks above the previous lower high, this indicates that sellers are weakening, and a bullish CHoCH may be forming, potentially leading to an uptrend. Recognizing a change of character early helps traders exit trades in time or prepare for upcoming reversal setups. Now that you understand break of structure and change of character, let's explore the idea of internal and external structure, a key concept for multi-timeframe price action analysis. The external structure represents the overall trend of the market. It is the big picture formed by significant swing highs and swing lows. We usually identify external structure on higher time frames. Think of the external structure as the skeleton or roadmap of the market. It gives structure to your trading decisions. Internal structure, on the other hand, represents the smaller price movements occurring within those major swings, usually visible on lower time frames. These include minor highs and lows that make up retracements and consolidations. Understanding both helps traders time entries more accurately. Let's illustrate these concepts by applying to a real chart example. In this example, the external structure on the higher time frame is clearly in an uptrend. A significant swing high is formed, and price breaks above the previous high, creating a new higher high. This is a classic break of structure, a clear signal that the bullish trend is continuing. Soon after, price retraces slightly and once again breaks a previous high, confirming yet another bullish break of structure. However, here's where things change. Price suddenly breaks below the last higher low of the uptrend. This is what we call a change of character, a powerful indication that the bullish momentum might be coming to an end, and a potential trend reversal to the downside is beginning. This is the external structure on D1 chart, which shows the overall shape of the market. To strengthen our analysis, we switch to the internal structure. On the H4 timeframe, we observe a new series of lower lows and lower highs forming, which confirms the break of structure. A change of character in the external structure. A break of structure in the internal structure. This confluence between internal and external structure gives us a high probability signal that the market sentiment is shifting downward. Now that we have structural alignment, what's the next step? We mark key levels on the chart, particularly areas of supply and resistance zones, which could serve as potential reversal points. If price pullback to these zones, we watch closely for confirmation signals, such as bearish candlestick patterns or bearish continuation patterns. Upon confirmation, we confidently enter a sell trade, as the probability is high that price will continue to move downward. In the next example, the external structure on the H4 chart is in a clear downtrend. Price is consistently forming lower lows and lower highs, and we can identify a recent break of structure, reinforcing the bearish momentum. Now, let's zoom into the internal structure on the H1 chart. Here, we spot a supply zone near the previous lower high of the external structure. The internal structure also shows break of structure in full confluence with the external structure. Also, a Marubozu candlestick pattern forms at the supply zone. This indicates a potential shift of momentum to the downside. Once the setup is confirmed, we enter a sell position because there is high probability that the price will continue its downtrend. Place your stop loss just above the recent lower high on the internal structure. Set your take profit at the previous lower low identified on the external structure, aligning your target with the broader market direction. Remember, market structure is the language of price. Learn to read it, and the market starts speaking to you. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.